Welcome back to Squawk Box. Tough quarter for Disney. The company saw a sharp drop in profits, a stunning reversal from where things stood just 6 months ago. Disney said that the COVID-19 outbreak cost it $1.4 billion in operating income. The company is also suspending its dividend payment for the first half of its fiscal year. We're joined now by Jessica Ehrlich, Bank of America Securities, Senior U.S. Media and Entertainment Analyst. I got to tell you, Jessica, I was reading that this morning. So what are they saving with the dividend suspension? Like $1.6 billion.
$1.6 billion.
1.6. My idea. See, I've never done. I haven't taken accounting. I'm not a CFO. I would raise the dividend today and save $2 billion for the next 6 months. Would that work? Does that make sense? No, I'm kidding. But anyway, that probably isn't going to. That's not a good idea. The overall numbers that you saw there, worse or better than what you thought?
It actually was a little bit better. Second quarter operating income was a little bit better. Not that it's relevant. I mean, we're going into the third fiscal quarter, which will be peak losses. Revenue, essentially, there's barely revenue for the quarter. We're projecting down 40%, and the losses should be at peak. I mean, the third quarter, the June quarter should be the worst before the world starts to reopen.
You have a buy on it still, and that we were talking about it earlier. I don't know if you were watching, but it's clear that Iger worked years and years to gather these fantastic assets. And some people think he overpaid at different times, but the proof was in the pudding on how well the company was performing. Those assets are still part of the company. So do we assume that that eventually those come back and become very valuable again, or is the mix not right because it's going to be a new world and there's too much emphasis on theme parks globally?
You know, it feels like we're at peak negative sentiment. Disney does have a bullseye on its back. We know all of its businesses are impacted, from theme parks, cruise ships. You go through it, movie, TV production, advertising, sports, etc. Every one of their businesses is impacted in some way. Having said that, you know, we are at peak negative sentiment, and the fourth quarter we're starting to see the world trying to reopen slowly, and there's really strong demand for their product. So the question is not will there be demand, it's when will there be demand. So there's clearly demand. Whether it's you look at the ratings on ESPN from the NFL draft where they did a fantastic job, or ABC with their sing-alongs. I mean, there is demand. I thought one of the more shocking things they said on the call last night was the demand for cruises. Like, people want to get back on cruise ships.
Unbelievable, yeah.
The last thing that you would think that anyone would want to do. So you can see, sorry?
No, I just said reading your caveats and your notes about what could go wrong. It's like it had nothing to do with the pandemic. It's the same old stuff. Cord cutting, problems at ESPN, things like that are still the worries and concerns about Disney's future. But I guess that all assumes that someday, we open up society and we're not feeling too much of the effects of this pandemic that we're seeing right now. How many employees come back, do you think?
You know, this is a chance for all companies to really take a look at their businesses strategically and from an operating efficiency standpoint, and really examine what their businesses look like. So of the 120,000 furloughed employees, not clear how many do come back on a permanent basis. I mean, initially costs will be higher because they're going to have to clean more and do testing as people come into their properties. But over the long term, has demand really changed for live events and interaction? It will take time, but will you get a chance to buy Disney at these levels again? Because Disney and your parent company, Comcast, with NBC Universal, have very unique assets, and they can't really be duplicated, and they have scale.
Right. We're going to talk about that after Andrew has a question, but I want to talk to you about, we were talking about Comcast earlier because of the last time you were on. I don't know if you remember, it was pretty funny. But I want to see what Andrew, let Andrew in, then we'll get back, and I'll ask you my question about Comcast. Go ahead, Andrew.
Jessica, I just had one quick question that relates to the theme parks, which is, Bob Chapek spoke about this idea of opening Shanghai in May at apparently up to about 30% cap in terms of the number of people who can get in there because of the social distancing. And I was curious, in terms of the math that you've done, or if Disney talked about it, what kind of capacity do they need to be profitable and be open? Meaning, at a 30% capacity being open, given the additional costs that you're talking about, is that even break even? Do they lose money staying open at those levels? What do they have to get to make the economics of it all work, let alone the kind of outsized profits that they've historically been able to achieve?
Disney was not very helpful on the call last night in terms of sizing the impact. Most of the costs, the majority of costs are variable. And so there will be these initial openings. They weren't helpful. Having said that, our guesstimate of where they can at least break even would be in that 20 to 30% range for them, and same for Universal.